Also, a return to normal. Everybody is thinking that this is a safe market. Things are going back to normal. Inflation's getting under control. The Feds are almost done hiking. So Brian Moynihan just spoke, and he still believes recession is on the table for the third, fourth quarter, or possibly the first quarter of 2024. So we are getting into those innings here, and he thinks it's going to be mild, and the consumer is going to remain strong, and the job market's going to remain strong. And Morgan Stanley's Mike Wilson is still in the bear camp, even though this rally is ripping his face off, and he probably is ready to throw in the towel at any minute. As we've been seeing, a lot of people have been shifting back to more of a bullish thesis, but is now the time to become bullish? I'm going to talk through multiple expansion taking place right now. Am I behind it? Am I against it? And opportunities that I'm personally seeing. This is not financial advice, so let's get into it. So as the Federal Reserve is in a meeting between the 13th and 14th of this week, we also have CPI data hitting this week on Tuesday, June 13th. So the market is definitely going to be hammered with a lot of data points. We're going to figure out exactly what's going on and what the next move is for the Federal Reserve. And as we can see, the market is definitely front running this. The NASDAQ pushing nearly 1%, which is obviously going to help the S&P 500, as the S&P 500 is up nearly 0.5% as well, starting to get to a breakout point. And we're going to take it over to the charts here in a second, but I want to talk through a few different things. Earnings have contracted roughly 6.5%. But we're getting multiple expansion here as we're starting to push a 22 PE ratio while earnings are actually coming down on the S&P 500. Now let's think about the top holdings in the NASDAQ and the S&P 500. We have Apple, Microsoft, Amazon, Nvidia, and Alphabet, Meta. These are companies that are definitely getting benefits from the AI conversation, which is forcing stock prices up, even though the earnings weren't extremely impressive. Now, this is a case-by-case scenario. I'm not lumping them all up, but I would say that Apple and Microsoft earnings are definitely in question now when you consider the multiple that they're receiving, which is now leading me to think about this scenario of multiple expansion on contractive earnings. To me, this is a dangerous game, and I think there's better opportunities out there, and I'm going to talk through this really quick here. So I want to talk through emerging markets really quick, as I think emerging markets is becoming an opportunity here, trading for a PE ratio roughly half of what the S&P is trading for. And we're starting to see emerging markets specifically are being priced for recession. So they are on sale when we compare it to the S&P 500. The S&P 500 is roughly 10% removed from the all-time highs. And as we can see here, EEM, emerging markets, iShares hit a high of $55, is trading right around $39, $40 a share. And so it hasn't really caught up to the move that the S&P 500 has had, but it's not really the S&P 500 that's been moving. It's been the top 10 names. I think we all know that. When we look at an equal weighted S&P 500, it's up roughly 3 to 4% now, which is now making me look at kind of contrarian opportunities. One being the emerging markets, and number two is going to be the long end of the yield curve. You can use TLT, ZROZ, similar setups here where I'm looking at the long end of the yield curve and I'm saying, historically, this is extremely cheap. And if we do head into some sort of slowdown and or recession, I think we will see an opportunity both for emerging markets to outperform and the long end of the yield curve to outperform. So these are some areas that I'm definitely looking at more and more each day when I'm starting to see what is really taking place with the multiple expansion on earnings contracting. Basically, what I'm saying right now is that the majority of the S&P 500 is getting extremely expensive when we look at what their earnings are justifying. No growth and justifying a 30 multiple on a company like Apple is a little outrageous. I understand that Apple is going to be innovative going forward, but we have to remember that it is eventually going to come down to the fundamentals of the company and what we're paying for those fundamentals. And right now, it seems to be, in my opinion, that it is getting very expensive and that the AI boom here is causing FOMO. And when we think about what happens to investors here, This is a normal cycle, guys. This is a very, very normal cycle. So we've talked about cycles in the past, and I just want to bring it back to your attention as there are business cycles, but there's also investment cycles psychologically that takes place with investors. And if we think about what happened when we had stimulus passed, we were definitely in some sort of euphoric greed type mentality where we had this massive rally up through stimulus. People had time on their hands. We saw record amounts of brokerage accounts being open, and we saw record amounts of unsophisticated money entering the market. Not only entering the market, but actually taking on a lot more risk than normal, basically buying zero-dated options. And really, the meme population was going absolutely bananas. And I think we all can remember that. It wasn't that long ago that this happened. And we've definitely had a repricing in stocks. And I think the repricing in stocks had to do with interest rates being on the rise, fear of recession. We obviously had a war going on as well. And the number one battle that we are fighting is inflation. So these things definitely repriced assets. And I think it made sense that we had a substantial pullback from the highs because we've had earnings contracting. We had stimulus coming out of the economy. We have now a hawkish Fed versus a dovish Fed. Debt is now harder to get. Liquidity is now harder to get, which in turn is going to impact earnings. So I think the recent contraction in asset prices makes a tremendous amount of sense. The recent rally to me is not making sense here. And let me break down why that is and why historically this is a normal behavior. Not only to the return of normal as we have here, but it's also considered complacency. And as we all see by the VIX is now going to levels that we haven't seen in some time, which is signaling complacency. Also, a return to normal. Everybody is thinking that this is a safe market. Things are going back to normal. Inflation's getting under control. The Feds are almost done hiking. The problem is the lag of monetary policy has yet to be felt in this cycle yet, and that's where I'm pumping the brakes and looking at other opportunities, much like emerging markets and maybe the long end of the yield curve here. In my opinion, I don't think we've capitulated, and I don't think the worst is over just yet. We have to remember that banks just started to fail a few short months ago, and the market is completely looking past this and not thinking about what's going to happen to corporate earnings. And corporate earnings is why we buy individual companies. So in my opinion, when I think about the business cycle overall and where the investor is, I definitely think we're in a place of complacency, and we are also at a return to normalcy. And I think the reason why that is we've been in this bear markets or sideways market for an extended period of time, and everybody is looking for a reason to get out of it. It's been brutal, it's been frustrating, but is it truly over? And I just don't think earnings have been impacted enough to believe it, and I don't think monetary policy has been pushed through the system enough to really impact exactly what I think is going to take place here, which is earnings contractions and layoffs. These are going to be lagging indicators. Every single leading indicator we look at is saying that we're in recession, whether you want to talk about the inverted yield curve, ISM. And the one thing that we've been holding our hat on is the fact that the consumer still has money to spend and that the job market is very strong. But we're starting to just see cracks in that now. I'm roughly looking at a 78.6 Fibonacci retracement, basically taking the retracement from the recent highs down to the recent lows. And there we get around 43.84, call it 43.85. Let's just say we overshoot it. And that's about where I think we tap out, which is basically another 50 to 60, just a little over 60 points on the S&P 500 is where I think we have about left. And that puts us at the state of return to normal or complacency once again. And when we're looking at a VIX that recently hit 13 and it's definitely been elevated through this bear market. I just don't think the battle on inflation is won yet. I also don't think the hiking cycle has been felt through the true economy. And we are starting to see some cracks here, whether it's bank failures and layoffs starting. So I would just say, hold on a second here, guys. Yes, this rally is definitely impressive. And we've traded off of this bottom, which I've shared some of the stocks that I bought in this recent rally, Pfizer being one of them. Where else could we possibly put money to outperform the market? And I think the long end of the yield curve could make a lot of sense layered with emerging markets. As emerging markets is now pricing in recession, so you're basically buying emerging markets fairly reasonable here versus something like the S&P 500, which is basically getting multiple expansion on AI hopes that I just don't know is going to impact bottom lines immediately. And I think that we're going to see interest rates impact bottom lines before we see the benefits of AI, and therefore earnings are probably still going to contract, giving opportunity to buy at a cheaper price. Once again, this is just my opinion and kind of reviewing what I'm seeing here, but want to share that with you. Hopefully everybody enjoyed, and as always, appreciate your time. Thank you so much for spending it with me, and we will see you in the next one. Peace.